Wednesday, October 2nd, 2019, Maneco 64, home of alternative economics and contrarian views. So as I'm on holiday and we're in Florence, and I'll be busy tomorrow morning. Tomorrow morning we're going on something called a treasure hunt to tour the city to find out clues of this fake treasure hunt, which will help us learn about the history and all the different places in Florence. And tomorrow as well is my birthday, and I thought it would be more appropriate to do a video tonight after the close of the markets. It's 10:30 p.m. here in Florence, which means it's 4:30 p.m. in New York Eastern Time. And I think it's important to do a video today because it looks like a MOPE, or Management of Perception Economics, is unraveling. And what do I mean by that? Well, what I mean by that is the term MOPE has been used a lot by Jim Sinclair of JS Mindset. And basically that's the central bankers, the Treasury, the president. And it doesn't just mean Trump. It means all the presidents in the past, probably since I would say the late 80s. They've been working together to try to make people act in a certain way psychologically by managing the perception about what they say about the economy, especially the Fed, also the Treasury, to try to push people to do certain things, to act in a certain way, because they think they can influence how people spend and how the economy grows. But we all know that that's very, at least in my opinion, that's very, how can I say, it's kind of propaganda, right? Because if an economy is not doing well, it's not doing well. And you need to wait for things to turn around. Just because a chairman of the Fed or a chairwoman of the Fed or a Treasury Secretary comes out and says something different won't change things. And in my opinion, ever since the great financial crisis of 2008, this MOPE has gotten even worse. And it's come back to bite the economic banking establishment. And why do I say that? Well, because they bought so much into their MOPE that from early 2016 or late 2015, and then towards the end of 2016, they started raising rates because the economy was doing so great, right? And in my opinion, of course, the economy wasn't doing great. The US private economy, not only the US, but in Europe as well, like for example in the UK, if you strip out all the deficit spending from governments in the US and in the UK and some other European countries, the private economy has actually been in a recession since the collapse of 2008. And but the Fed officials, mainstream economists, they bought into their MOPE and they thought they could normalize things. And unfortunately, the Federal Reserve raised rates too far, and now things are imploding. And I think this is what we're seeing now. This is not about the trade wars or about anything else that's happening right now, like Brexit. This is about the fact that the Federal Reserve bought into its own spiel or MOPE and raised rates too far. They probably didn't have a choice either, because how can you have a great economy? How can you convince investors that you're credible and you have a great economy while rates are at zero or while you have a huge balance sheet, right? But they didn't have a great economy, and that's why we're seeing this now, in my opinion, and that's why it's unraveling. It's got nothing to do with what the mainstream is telling you, like trade wars or whatever else. Let's look at the markets. Amazing. Today again, my early video, the markets were up. Earlier this morning here in Europe, my wife and I went out today. We had a very nice time. We went to the Uffizi Gallery. That was amazing. I'd never been there. It's huge. It's got some beautiful, beautiful art. We spent about 2.5 hours there. I think we need to spend more time there. Hopefully we'll be able to go back. Not surprisingly, after yesterday's very weak numbers, the market has continued to go lower today. The Dow finished down 494 points, just under 2%. S&P finished down 52 points, about 1.8%, and the NASDAQ finished down 123, or 1.56%. Precious metals had a very good day, considering we were at 1458 yesterday in gold. That was the low yesterday, and that we're now just around 1500. Right now, as I'm talking here, it's 10:38 p.m. Florence time. We are at 1499.60. The range has been quite a wide range. 1474 low, 1505 high. Are we out of the woods in terms of precious metals? I don't think it matters. People shouldn't worry so much about the price, unless, of course, you're trading a paper, which I don't recommend. I think you need to be very careful about being in the system right now. I think things are unraveling. Silver, of course, had a very good day. I think the important thing is that gold and silver got back above some key levels that I've been talking about for over a week. Gold was 1483 and silver was 1730. So we're back above those levels. Silver right now is 1755. It's up almost 2% on the day, up 32 cents. And after the close, we're continuing to see the stock market go lower. We've got the Dow futures now down about 70 points. That's on top of the 494 that it lost earlier today. So things are not great. S&P is down 8 and NASDAQ 100 futures down another 25. I wanted to show you a chart of Fed funds rates going back 62 years. And it just shows you the gray lines are when you have recessions in the US. And you can see that every time that the Fed allows the Fed funds rate, or how can I say, sets a target, higher target to the Fed funds rate, the top of the cycle always coincides with the beginning of recession, almost every time here, as you can see. And I think it's not going to be any different this time. Why isn't there a gray, how can I say, bar there right now for a recession? Well, because a lot of recessions, sometimes the people who declare recessions, they actually are backward looking. So we still might have the people, I forgot what they're called. It's an economic statistics government agency. They still might call a recession, maybe later this year. Who knows? There's been a lot of revisions of the GDP after the ISM manufacturing number yesterday. That dropped to a 47 handle. Below 50, that means it's a contraction. I think what's happening now and what's happening to the economy, it's got all to do with the series of interest rate rises that we had from 2016 until late last year. Am I saying that the Fed should always keep rates at zero and keep printing money? No, I'm not. I don't even think there should be a central bank. I think interest rates should be set by the market, and that sound money, precious metals, should be the money used. The U.S. Constitution legislates for that, right? But in the world we're in, there's no way out. It's inflate or die, as I think it was Richard Russell who said that, the late Richard Russell. It's inflate or die. So the Fed can't raise rates or shrink its balance sheet anymore, or else everything would implode. And I think they did it too far. They did too far up until last year. And that's what we're seeing now. How will they react? Well, I think they're going to throw everything at it to the nth power compared to the collapse of '08. It's going to be, I think it's going to make it look like a picnic in '08. I even read an article this evening that Larry Kudlow is talking about making James Bullard, or from the St. Louis Fed, the new Fed chairman, maybe next year after the elections. Granted, Jim Bullard has been a hawk before, but in the last few years, he's the guy who's always come out when the stock market is crashing and made really dovish comments, right? So, yeah, watch that space there for the new Fed chairman, maybe James Bullard of St. Louis, sorry, not San Francisco. So, yeah, batten down the hatches, hang on to your precious metals, and try to avoid paper assets. Try to avoid leverage. Try to avoid debt as well, in my opinion. If you enjoyed this video, make sure you hit the like button. Subscribe to the channel if you haven't yet. And you can also follow me on Twitter, DTube, and Steemit. I'll probably try to talk to you tomorrow if I've got time. Maybe after the markets close again, if we have another eventful day. I wish you all a great day. Take care. Bye.